In this video, I'll be walking through the 7 levels of wealth in Canadian retirement, starting at $250,000 and we're going all the way up to $30 million. What actually changes at each of those stages? Through working with folks kind of across all of these levels, I've learned that wealth in retirement isn't necessarily just about a single number. It's about how much control, how much margin, and how much optionality your money gives you once kind of CPP, OAS taxes, and RIF rules all start interacting with each other. And the biggest mistake that Canadians make is assuming that simply kind of moving up to the next level fixes poor planning. So that's exactly why I'm going to make this video, to show you what each level actually looks like, what constraints you're working with at each level, and why the rules change as you move up that spectrum. Hey there, I'm Steve Willems, a wealth advisor with the Willems Wealth Planning Group out here in BC. On this channel, I help Canadians plan smarter retirements, reduce taxes, and make better decisions in the years that matter most. Now, before we get into level 1, I want to clarify what I mean by these dollar amounts, and just as importantly, like what I'm intentionally setting aside. Now, when I refer to like $250,000 or $1 million or $5 million in this video, I'm going to be talking about kind of investable financial assets. So things like RSPs, TFSAs, non-registered accounts, pensions you can draw from, or maybe proceeds from a business sale. I'm not going to be including the value of your primary residence in these levels. Now, that doesn't mean that I'm ignoring real estate or pretending it isn't real wealth. In fact, home equity is more concentrated than ever before. In the US, Federal Reserve flow of funds data shows owner-occupied real estate recently reached a record level, with home equity hitting an all-time high as well. And while Canadians don't track their data in exactly the same way, the reality is similar here too. For many households, their home is their single biggest asset. And of course, you can access that equity, right? You can downsize, you can relocate, you could rent, right? Especially in an environment here where we've seen asking rents in major Canadian cities like Vancouver or Toronto, they've fallen back to levels last seen in kind of early 2022. So in the right circumstance, unlocking home equity can absolutely fast track your progress through these wealth levels. But for the purposes of this framework, I'm just going to be setting housing aside for just one reason. A home doesn't replace a paycheck unless you can turn it into cash flow. These levels are about finding how much flexibility, how much control or like optionality your deployable capital gives you inside the retirement income system. Two households with the exact same net worth can live very different retirements depending on how much of their wealth is actually usable. So for clarity and like for consistency, I'm just going to be focusing here on these investable assets, while fully acknowledging that for many Canadians, home equity does represent a powerful lever that can change the math if and when they choose to pull that lever. So with that framing in mind, let me start at the bottom where the constraints are the tightest and the margin for error is the smallest. So at around $250,000 of investable assets, retirement can kind of best be described as fragile. At this level, the portfolio isn't really an income engine. It's more there to serve as a buffer. The heavy lifting is done by CPP, by OAS, and often by Guaranteed Income Supplement, or GIS, not by personal savings. Using a rough kind of like rule of thumb, $250,000 at a 4% withdrawal rate is going to produce about $10,000 per year of income. That typically means like 70 or maybe 80% of your total retirement income is going to be coming from government programs. In many cases, careful income management is going to be required here to remain eligible for GIS because even modest withdrawals can reduce or eliminate it. That reality is going to drive almost every single planning decision at this level, right? Spending has to stay tight. There's very little margin for error. Timing mistakes can hurt pretty quickly. A market decline in early retirement isn't something that you can kind of like rebalance around. Like it directly reduces your lifestyle. A large unexpected expense, a furnace replacement, or a car repair can permanently damage or change the plan. CPP decisions at this level are often made out of necessity, right? Like not strategy, but just like I need the money. Many people will take CPP early at this stage because they just need the cash flow. Like it's just the way that it is. There's also very little tax planning available at this point, right? Income is already low, marginal tax rates are minimal. The objective isn't like optimization, it's just preservation of the benefits and the stability of that cash flow. For homeowners at this level, retirement planning often extends beyond investment accounts, right? Tools like the provincial property tax deferral programs, for example, out here in BC, they can play a pretty important role to manage that cash flow. Deferring property taxes can help you maintain that cash flow and allow people to stay in their homes for longer, even though it does increase, obviously, the eventual claim against the estate or the future sale proceeds from that home. Programs like this are often eligible for folks who are 55 years and older or for other qualifying categories, and you end up getting charged a pretty low rate of simple interest. Out here in BC right now, it's 2.95% here this year. The simple interest just means that you're only charged interest on the principal deferred amount that has been deferred, but you're not charged interest on top of the amount of interest that's already owed. There's no income or asset test on this program, so it does technically apply to homeowners kind of all the way through the next few levels as well. Now, this level of retirement can work. Many Canadians live right here at this level, but it's sensitive. The system leaves very little room for mistakes, and success often depends kind of more on restraint, benefit coordination, and kind of downside protection than, clever planning. Now, at around $500,000 of investable assets, retirement becomes viable, but it's still going to feel constrained. At this level, the portfolio is going to start to contribute meaningfully to the income levels, but government benefits are still going to be doing a lot of the heavy lifting. Using rough math, $500,000 at a 4% withdrawal rate is going to be producing about $20,000 per year of income layered on top of CPP and OAS. This can support a modest, stable lifestyle, especially if housing costs are low. The mortgage is already gone. But this is an important distinction. $500,000 rarely supports a clean early retirement. For most people at this level, like retiring 5 or more years before the age of 65 and fully replacing income is just not going to be realistic. There's usually isn't enough capital to bridge the gap before CPP and OAS begin without taking meaningful risk. So what we often see here instead is a gradual slowdown, right? Work shifts from kind of full-time to part-time. Savings perhaps stops when that shift happens, and the plan becomes more about coasting, not continuing to accumulate. When the mortgage disappears and savings is no longer required, a combination of reduced employment income and modest portfolio withdrawals often can be enough to make things work at this level. Market volatility is still going to matter, right? A poor sequence of returns early on can certainly tighten cash flow pretty quickly. Likewise, large expenses here are going to be more manageable, but they still might leave a bit of a mark. From a planning perspective, there's still going to be some room to coordinate decisions here, but not a lot. CPP timing becomes a choice for some folks, but often it's still going to lean kind of earlier than ideal because cash flow is going to matter. OAS clawbacks generally aren't going to be an issue at this point, but income still needs to be monitored carefully, especially if GIS might actually be in play. Tax planning exists at this level, but it's going to be basic, right? The focus isn't on lifetime optimization. It's about avoiding obvious mistakes and kind of preserving that flexibility. And so this is the level where many Canadians are, right? Like they'll think, okay, I think we're okay. And usually they are, as long as their expectations are realistic and the plan stays disciplined. Retirement works here, but it kind of works within these boundaries. Now, around $1 million of investable assets, something important changes. For the first time, retirement here starts to feel flexible. The simple math, like $1 million at that 4% withdrawal rate works out to about $40,000 per year of income. You layer in CPP and OAS, and kind of you're looking at $70,000 to $90,000 of kind of total gross income once all those pensions are online. But the real shift at this level isn't just about the math. It's often actually about a feeling. It's about confidence. People at this point seem to kind of start to trust their numbers, right? They're giving themselves permission to think about things that they wouldn't have considered earlier, maybe working less, changing roles, or retiring before kind of like the traditional age. Some form of early retirement certainly becomes possible here. But again, it's still going to be conditional. Like to save $1 million, most people need pretty solid employment income. So the key question here becomes, what does your lifestyle actually cost and when, right? If someone needs $80,000 per year of after-tax spending and they want to retire 5 or 6 years before their CPP and OAS are going to start to kick in, that plan could feel pretty tight. Bridging those early years puts real pressure on their savings, on their portfolio, and the sequencing risk really matters. But if the burn rate is lower, right, if the goal is simply to just be done working, but not to dramatically increase their spending, early retirement can often get a mathematical pass at this point. So from a planning standpoint, this is where coordination starts to matter. At this level, you'll likely have a few different buckets that can all produce different types of after-tax effects. Right, so you're going to want to start to think about kind of smoothing out RSP withdrawals. You want to think about perhaps testing intentionally delaying CPP, you'll want to think about managing taxes across these different account types and then building in some type of buffer for those surprises when they inevitably happen. Right? Bad planning can still create problems here, right? Like unnecessary taxes, lost benefits, perhaps even like avoidable stress. But for the first time, you have enough capital to kind of make real choices. At $1 million, like retirement isn't necessarily like carefree, but folks tend to feel less boxed in. At around $2 million of investable assets, retirement stops being about whether it works and it starts being about how it works. At this level, most people no longer need to think much about their basic lifestyle burn rate. Like the day-to-day expenses are fundable. They know where that cash flow is coming from. Many of the bigger ticket items have actually already been purchased, or they're simply kind of like no longer aspirational, right? The question isn't, can I afford this? It's what's the cleanest way to make this thing happen? And that's where this shift occurs, right? Taxes at this point are going to start to become a pretty significant enemy to the plan, right? A reasonable lifestyle can be funded with pretty basic planning, right? But how income is created now matters more than how much you have. This is where sequencing, account choice, and timing decisions are going to start to dominate the outcomes, kind of the paths that might be presented forward. Risk sizing here also matters more. We probably have more than enough. So how does that affect our desire or maybe our capacity to take risk with our money? A CPP delay decisions are also going to become very important here because you no longer necessarily need CPP early, but delaying it meaningfully might reduce pressure on the portfolio later on in life and perhaps let you to solve for other outcomes. OAS timing is also going to become pretty strategic at this level. In some cases, it might make sense to delay activating OAS in order to buy a few years of intentionally drawing down your registered accounts before those income-tested benefits come online. This is also going to be the level where people start to give themselves what I'll call like real permission, right? Like bigger trips than they've ever done, vehicle upgrades that they wouldn't normally do, lifestyle spending that kind of doesn't follow the plan to the dollar. And generally, like most of those things will work. This is where what I often call the 3-digit rule kind of starts to show up in practice, right? The only 3 digits of your net worth that really matter are the left 3. So if you have $2,576,574, the $6,574 all the way up to $9,999 doesn't really move the needle. At this level, people stop worrying about rounding errors and they start planning in ranges, and that's entirely appropriate. But here's the catch. At $2 million, small inefficiencies become very expensive. This is where we'll often see planning mistakes that feel minor, but they have outsized consequences. A pretty common example is a large non-registered portfolio producing taxable income that isn't actually needed for spending, right? Imagine someone with $1 million in a non-registered investment account as a part of like a $2 million portfolio running an investment strategy that's throwing off $50,000 per year of taxable income. If that income is taxed at a 30% marginal tax rate, that's $15,000 per year lost to tax like every single year simply because the portfolio wasn't structured with intent. The investment plan hasn't been synced up with the income plan, and the cost of that poor coordination is tax. At this level, retirement planning becomes strategic, right? The difference between good and bad planning isn't comfort versus discomfort, it's control versus friction. And over time, those small decisions can easily add up to 6 figures of unnecessary tax, lost benefits, and probably avoidable stress. And hey, if you're around this level and kind of starting to realize that taxes and sequencing matter more than the returns themselves, this is exactly the stage where getting a second set of eyes can make a meaningful difference. If you want help stress testing your plan, you can book a call using the link below. Would be happy to chat. At around $5 million of investable assets, the dominant kind of like emotion or statement that we'll hear at this point is pretty simple. They'll say, "This is better than my younger self could have ever imagined. The one thing I don't want to do now is have to go and re-earn it." That framing is pretty important because this is where the mindset of folks seems to shift clearly from growth to preservation. At this point, more often than not, it seems people aren't trying to as aggressively compound anymore. They've already won the game in ways that probably their past self probably could have never imagined. The goal is to now keep what they've earned, like to enjoy it and to avoid kind of any unnecessary screw-ups. So this shift often is subtle, right? Portfolios don't all of a sudden become like ultra conservative, but the intent changes. Risk tolerance, it tends to like tighten up a little bit. Volatility often matters more emotionally, not because like the swings are bigger, but because the dollars are, right? Like a 20% pullback on a $5 million portfolio, like pot of money, it's $1 million. And our crazy monkey brains, they sound the alarm when we lose $1 million. They say like, hold up, bucko. That's a lot of bucks. So from a planning standpoint, early retirement at this point is fully on the table, assuming the person isn't stepping away from like an extremely high 7-figure employment income, right? The type that you'd often see with like a key kind of executive sales roles. The portfolio at this point could pretty comfortably support most lifestyle needs, certainly well before CPP and OAS would ever kick in. But this is also where registered accounts can become kind of dangerous. If a large portion of that $5 million is sitting inside RSPs or RIFs, this level also demands a deliberate RSP meltdown strategy in the early retirement years. Otherwise, mandatory RIF withdrawals later on can create some pretty enormous and unnecessary amounts of tax friction. OAS is usually fully clawed back by this stage. CPP timing decisions, they're still going to get made, but in the context of the overall plan, they're often just rounding errors, like not outcome drivers. The real enemies at this point are tax. And I'm talking about like the year after year tax and also the estate tax at the very end of the plan. There's also still a few things that can blow people up at this level, and they tend to come from how the wealth was created. If the money arrived quickly, like through some concentrated private business sale or maybe a handful of hand-picked stocks, like publicly traded stocks, we sometimes see overconfidence bleed into future decisions. That can show up as like either excessive concentration or flippant spending on things like recreation properties that kind of maybe feel affordable, perhaps even self-justified, but because they don't add income, utility, or long-term value, they can have the effect of narrowing optionality into the future instead of expanding it. At this level, planning also starts to expand beyond the individual. Right? We might begin restructuring ownership of certain assets, like sometimes family trusts will come into the picture, maybe intergenerational gifting strategies or pulling forward estate planning decisions. That all might become relevant at this point, not because these things are exotic tactics, but just because the size of the numbers makes early action more meaningful. At $5 million, retirement planning is no longer about creating income. It's about preserving control, right? Trying to minimize leakage into all of these different areas and just making sure that the system doesn't quietly take more than it needs to, both now and later on down the road. Now, once investable assets reach the $10 million range, the internal dialogue changes in a very predictable way. People stop asking, can I fund my lifestyle? That question has already been answered, and pretty decisively. They also understand something else, often for the first time with a whole lot of clarity. There is no realistic scenario where they can spend through this money in their lifetime. They crossed that line years ago. And so when that realization lands, the focus naturally shifts to meaning. What is this money actually for? What do I want it to accomplish? What kind of impact do I want to have? And this is where philanthropy moves from being like a tax strategy or an accidental, like sporadic afterthought into something a lot more intentional. At this level, people begin to believe, like rightly, that they can actually leave a dent on the universe. And not in some like symbolic way, but like a meaningful way. Like they can actually solve a real problem that they see in their community, in a sector that they care about, or maybe even in the world more broadly. And so the questions that tend to come up at this stage are like, what causes do we care about? Do we want to give like reactively, or do we want to build something more enduring? Do we want this exercise to be individual? Do we want to lead it? Or do we want to bring our family into this conversation? Philanthropy becomes a place where values tend to meet action. And importantly, it becomes one of the first areas where people start thinking beyond themselves without yet having to kind of like redesign their entire family system. And that naturally leads to the next level. As wealth grows into the $30 million plus range, planning stops being about individuals and it starts being about systems. And forgive me for getting a little nerdy here. At this scale, families are no longer managing money. They're managing relationships, they're managing expectations, and they're managing future ownership. And so without structure, uncertainty tends to fill in these gaps. In my work as a family enterprise advisor and FEA, for those who like acronyms, this is often where I'm brought into the conversation, not to talk about investment strategy or tax rates, but to help families think through how they want to operate together over time. That's right. There are families who actually talk about how they want to operate. Transparency becomes a pretty central theme here, and it's a bit nuanced. Not every family leader wants full financial disclosure, and that's completely understandable. Transparency exists on a spectrum or a continuum, but what I've seen consistently is this. In the absence of clarity and transparency, family members will start to fill in the blanks themselves, right? Kids and beneficiaries, they're not naive, right? They notice patterns, they hear fragments, they make assumptions. If you have some public profile, they can probably look some of this stuff up. Some of those assumptions may be true, others may be wildly off. And many of the worst misunderstandings could have easily been prevented with just thoughtful communication a little bit earlier on. And so this is where we're going to see family governance enter into the picture. Often families don't jump straight into formal structures. They kind of on-ramp gently. And one of the most common entry points is, again, philanthropy. Making philanthropic decisions together as a family creates a shared objective. It gives families a reason to sit at the same table. It opens the door to conversations about values, about priorities, about decision-making, and about stewardship without immediately touching every single potential sensitive topic that exists within a family. What tends to happen is from there, governance evolves naturally, right? Families will begin kind of to establish rhythms, right? Perhaps a cadence for regular meetings, shared learning experiences, kind of agreed upon ways that the family is going to make decisions. Over time, they'll tend to formalize this into some type of like guiding principles or maybe even a family charter, which would be like a living expression of how they intend to work together to resolve differences and to prepare that next generation. The purpose of all of this seemingly bureaucratic activity is to reduce the likelihood of future conflict by replacing silence with process, to prevent the need for future uprisings. Good governance doesn't eliminate disagreement. It's just going to give families a way to handle it constructively. It's going to attempt to strengthen cohesion. It's going to support learning. It's going to create space for multiple voices at the table, all while preserving flexibility. At this level, retirement planning is no longer about income. It's no longer about drawdowns or tax brackets or anything like that. It's about stewardship. It's about what can we do to maintain what we have? This wealth will exist well beyond yourself. And so the biggest area you need to invest in here is into the relationships that will be tasked with carrying that wealth on into the next generation. So the wealth that created opportunity for one generation becomes the foundation, not like a fault line for the generations that follow. The universal mistake that exists at every level of wealth is assuming that the next tier fixes today's problems. And if we're honest, most of us have seen this play out in our own lives, right? Like we set a target, we hit it, and instead of relief, we often notice something else waiting for us on the other side. It's kind of like climbing a mountain, right? Like you reach the peak you were aiming for, the milestone you told yourself that would change everything. And then you look up and there's another peak behind it. It's not a failure of planning. It's just the human experience. What does change as you move up the levels is your capability, right? Every stage gives you more competence, more perspective, and more tools to deal with the challenges that are inevitably going to come next. But the challenges, they don't disappear, and the stakes do increase. Every level amplifies the quality of your decisions. Good planning compounds, but poor planning compounds too. And so at the lower levels, the consequences show up as like stress and constraint. At the higher levels, they show up as tax friction, loss of control, and maybe even fractured relationships. And even at the very top, the core issues aren't even financial at all. They're human. They're about relationships and communication and alignment and the ability to make decisions with other people, not just for yourself. And that's why the goal of wealth isn't to win the game. There is no final scorecard. The real objective is independence, right? The ability to say no, to choose to play a different game, to design a life that actually reflects your values rather than reacting to the constraints imposed by money, taxes, or fear. And that's true whether you're managing $500,000 or $30 million. The numbers change, but these principles don't. So hey, if you want help understanding where you actually sit on the spectrum and what planning priorities matter the most at your level, you can book a call using the link below. We'll look at your numbers, your timing, your goals, and map out what matters most where you're at. Not just someday, but here right now. That's all I got for you today. I hope that helps you think through kind of where you're at and where you're trying to go. Thanks as always for watching. I'll see you in the next one.